In Seminar 1, I learned how banks and other depository institutions can be exposed to money laundering. In Seminar 2, I widened the lens. I now learned that money laundering does not only happen through banks. Criminals can also exploit credit cards, money services businesses, insurance products, securities accounts, casinos, precious metals, real estate, trade, corporate vehicles, virtual currency, and even charities. This matters for the CAMS exam because many questions are really testing one core skill. Can I recognize where value is moving, what is being hidden, and why the activity does not make sense? This video is for educational purposes only. It is not legal advice, regulatory advice, exam provider advice, or employer-specific guidance. Today, I am going to learn this in a very deliberate way. I will hear the concept in plain English. Then I will hear the exam-ready idea. Then I will connect it to a practical financial crime example. Then I will connect it to a practical financial crime example. Then I will link it to how AML controls are generally applied in real life. Then I will hear a short memory hook. Then I will reinforce it in first person so I can remember it better. This lesson is written in first person on purpose. Instead of only hearing definitions, I'm going to hear the material as statements I can repeat to myself. That helps me turn passive listening into active learning. So when I hear, I understand that a credit balance can be abused when illicit funds are overpaid onto a credit card and then refunded. I am not just listening, I am rehearsing the answer in a way I can remember. This format is designed for repeat listening. The first listen is for understanding, the second listen is for memory, the third listen is for active recall, where I pause and explain each concept out loud. So here is my roadmap. In this lesson, I will cover non-bank financial institutions, non-financial businesses and professions, trade-based money laundering, new payment methods, misuse of corporate vehicles, terrorist financing, and the main CAMS exam traps inside all of them. Section 1. Why Seminar 2 matters. Seminar 2 matters because criminals do not care whether value moves through a bank, a broker, a casino, a legal structure, or a digital payment method. They care about what helps them move, disguise, store, or legitimize value. So when I look at AML risk, I do not just ask, is this a bank? I ask a wider question. Does this product, service, business, or structure allow value to move quickly, anonymously, across borders, through weak controls, or in a way that hides who really owns it? That is the real logic of this seminar. I understand that AML risk is not limited to banks. I look for any product, service, business, or structure that can move, store, disguise, or legitimize value. Memory hook. AML risk follows value. Section 2. Credit cards and credit balance abuse. A credit card is a card with a credit limit that lets a customer buy goods and services or obtain cash advances on credit. Later, the customer repays what is owed. Credit cards are usually not the most obvious placement tool because they often do not involve large anonymous cash deposits directly into the account in the same way as a bank account, but they can be useful in layering and integration. One of the main CAMS concepts here is the credit balance. A credit balance exists when the total credits on the card exceed the amount owed. In simple terms, the card issuer now owes the customer money. I must remember credit balance equals sign the card issuer owes the customer money. So I imagine this. I owe $1,000 on my card, but I pay $3,000. Now I have overpaid by $2,000. The credit card company now owes me $2,000. If I ask for a refund check or a transfer, that refund may look cleaner because it now appears to come from the card issuer instead of the original criminal source. That is why overpaying a card and requesting a refund is a classic red flag. Other risks include offshore card accounts, especially where secrecy laws make the real owner harder to identify or the account information harder to obtain. So what do AML controls usually look like here? They include customer due diligence, monitoring for unusual overpayments, looking for sudden refunds, identifying payment methods that do not fit the customer profile, and escalating suspicious patterns. When I see a CAMS question here, I remind myself not to confuse normal card repayment with suspicious card behavior. Paying a balance in full is not the issue by itself. The issue is unusual overpayment, rapid refunding, and a pattern that looks more like moving value than managing credit. I now know that credit card abuse often involves overpayments, credit balances, and refunds. Memory hook. Credit balance means the card company owes me money. Section 3. Third-party payment processors. A third-party payment processor is usually a business customer of a bank that processes payments on behalf of merchants and other businesses. The problem is that the bank may know the processor, but not the underlying merchants very well. That creates a visibility gap. If I only know the processor, but I do not truly know who that processor is acting for, then I may not really know whose transactions are flowing through the account. That is why this area is risky. Red flags include high return rates from unauthorized transactions, multiple banking relationships, high-risk underlying merchants, nested or indirect processing arrangements, and transaction patterns that do not fit the stated business model. In practice, AML controls here include stronger due diligence at onboarding, understanding the processor's merchant base, monitoring return rates, reviewing payment flows by merchant type, and asking whether the processor is servicing sectors that are already high risk. I now know that the risk is not only who my customer is, the risk is also who my customer is processing for. Memory hook. Know the processor, but also know the merchant behind the processor. Section 4. Money services businesses. A money services business, or MSB, typically includes businesses such as foreign exchange dealers, check cashers, issuers of travelers' checks, or money orders, money transmitters, and providers or sellers of prepaid access. MSBs are not automatically suspicious. That is important. They provide useful services. They can be attractive to underserved or unbanked customers. They may operate longer hours, serve areas with limited banking access, and allow international transfers without a full banking relationship. So the CAMS lesson is not MSBs are bad. The lesson is MSBs are useful, but vulnerable. Why are they vulnerable? Because they often involve cash, speed, cross-border movement, agents, high transaction volume, and shorter or more transactional customer relationships. A money transmitter, for example, may accept value in one place and pay out corresponding value somewhere else, sometimes through intermediaries. In some jurisdictions, informal systems may be referred to as hawala or underground banking. I must remember that MSB risk equals sign cash plus speed plus agents plus cross-border use. Open-loop prepaid access can be used broadly across payment networks. Closed-loop prepaid access is limited to a specific merchant or issuer. That distinction matters because open-loop instruments are generally more flexible and can present greater risk. Common MSB red flags include frequent purchases of instruments just below thresholds, multiple people working together, use of the same identification across transactions, use of multiple locations in a short period, and altering behavior to avoid record-keeping or reporting requirements. In real life, AML controls here include risk-based policies, a designated compliance officer, training, independent testing, record-keeping, suspicious activity reporting, and transaction monitoring. If agents are involved, the principal still needs to think carefully about oversight and responsibility. I now know that MSBs are not automatically suspicious, but they require strong controls because they can move money quickly, sometimes with less traditional banking friction. Memory hook. MSBs move value fast. Section 5. Insurance companies. Insurance is not always the first sector people think of in money laundering, but certain insurance products can be very attractive to launderers, especially products with investment or cash value, such as life insurance and annuities. The issue is not ordinary insurance protection. The issue is when the product can hold value, accept significant funds, and later release funds in a cleaner form. Examples include overfunding a policy, moving funds into and out of the policy, redeeming it early while accepting a penalty, using the free look period to cancel after paying the premium, or requesting refunds during a legal cancellation period. So the red flag is often behavioral. Is the customer genuinely interested in insurance, or do they seem much more interested in cancellation, redemption, withdrawal, and refund? Another risk is the role of intermediaries. Brokers may have a lot of influence, and in a sales-driven environment, AML concerns can be overlooked if the focus becomes selling the product rather than understanding the source of wealth and source of funds. AML controls here include identifying the customer, understanding source of wealth and source of funds, watching for unusual premium payments, questioning third-party funding, reviewing early surrender activity, and escalating unusual patterns. I now know that the red flag is not simply buying insurance. The red flag is when the customer seems more interested in moving money, canceling, refunding, or withdrawing than in insurance protection. Memory hook. Insurance laundering often looks like money going in, then money coming out cleaner. Section 6. Securities broker-dealers. The securities sector is vulnerable because it is fast, international, liquid, and layered with intermediaries. A securities account can look respectable, but sometimes it is being used less like an investment account and more like a pass-through account. That is the key CAMS idea here. Risks increase because of the international nature of markets, the speed of transactions, the routine use of wires, the ease of converting holdings to cash, the use of nominees or trustees, and commission-driven environments where revenue pressure can weaken controls. Common red flags include an undisclosed principal behind the customer, multiple related accounts with large inter-account or third-party transfers, sudden unexplained wire activity, rapid liquidation after supposedly long-term purchases, unusual activity in penny stocks or bearer-type instruments, and accounts with high money movement but little real investment logic. So I ask, does this account activity make investment sense? If it does not, I become more alert. In real AML practice, controls include KYC, beneficial ownership identification, screening, source of funds review, monitoring trade and wire patterns, escalation of unusual activity, and suspicious activity reporting where needed. I now know that broker-dealer risk is often about whether the account activity makes investment sense. Memory hook. If it looks like a bank account with wires, not an investment account with strategy, I pay attention. Section 7. Casinos and gambling businesses. Casinos are classic money laundering settings because they can turn cash into something that looks more legitimate. A person can buy chips with cash, do very little gaming, and then cash out. Or they may use the cage mainly for banking-like services. Or they may structure transactions to avoid reporting. Or they may ask for winnings in a more respectable form, like a check. That is why casinos are usually associated with placement and layering. I must remember that casino risk equals sign cash in, minimal gaming, cleaner payout. Online gambling adds another layer of risk because it can involve cards, online payment systems, and cross-border transactions. Red flags include minimal gaming with no good explanation, using the cage mainly for deposits and withdrawals, hedging behavior such as betting both sides to minimize loss while creating a gambling trail, and patterns that suggest the person wants a legitimate-looking payout more than a genuine gambling experience. AML controls in this area include monitoring chip purchases and redemptions, looking at gaming to cash out ratios, identifying structured behavior, understanding source of funds for higher risk customers, and escalating junket or intermediary risks where relevant. I now know that the red flag is not gambling itself. The red flag is buying in, barely playing, cashing out, or requesting funds in a more respectable form. Memory hook. Casino laundering turns cash into the appearance of winnings. Section 8. Precious metals, jewelry, art, and high-value items. Gold and other high-value items are attractive because they store value in a portable form. Gold has high intrinsic value, can be transported relatively easily, can be bought and sold readily, can often be purchased with a degree of anonymity, and can be melted or reshaped while still holding value. Art, jewelry, and other luxury items can also help store or move value. Some of these markets involve subjective valuation, dealer discretion, and cross-border trade. That makes them useful not only for storing illicit wealth, but also for moving it outside the ordinary banking system. AML controls here often depend on the jurisdiction, but the basic questions stay the same. Who is buying? Who is really behind the purchase? How is it funded? Does the customer profile make sense? And is the valuation or deal structure unusual? I now know that high-value goods are attractive because they can hold value, cross borders, and be resold. Memory hook. Small item, large value. Section 9. Gatekeepers and professional facilitators. Gatekeepers are professionals such as lawyers, notaries, accountants, auditors, investment advisors, and trust and company service providers. They matter because they can either block or facilitate the entry of illicit money into the financial system. If a criminal wants to create a company, buy property, structure a trust, move client funds, or build a respectable-looking legal arrangement, a gatekeeper may be involved. Most professionals are not complicit, but from a CAMS perspective, the risk is that professional credibility can make suspicious activity look legitimate. Common vulnerable functions include creating corporate vehicles, buying or selling property, performing financial transactions for a client, giving tax or financial advice, providing introductions to financial institutions, undertaking certain litigation structures, or setting up and managing charities. AML controls here depend on the profession and jurisdiction, but the core logic is due diligence, beneficial ownership review, source of funds, understanding, record keeping, and escalation when the transaction structure does not make sense. I now know that gatekeepers matter because criminals may use professional services to create a respectable appearance around illicit funds. Memory hook. Gatekeepers can open the gate to legitimacy. Section 10. Trust and company service providers. Trust and company service providers, sometimes called TCSPs, help create, manage, or administer legal entities and arrangements. That can include forming companies, arranging directors or secretaries, providing registered offices or correspondence addresses, acting as trustees, or arranging nominee shareholders. Again, these services are often legitimate, but they are highly relevant to money laundering because legal structures can hide who really owns, controls, or benefits from the assets. So the main AML question is simple. Who really owns or controls the structure? If I cannot answer that clearly, risk rises. AML controls here include identifying beneficial owners, understanding the purpose of the structure, reviewing nominee arrangements carefully, screening the relevant parties, and escalating when the structure seems more focused on obscurity than on commercial logic. I now know that the main question with trusting company service providers is who really owns or controls the structure. Memory hook, structure can conceal control. Section 11, real estate. Real estate is attractive to launderers because it can absorb large amounts of money and convert them into a stable-looking asset. A property can be purchased with cash or through an all-cash style transaction. Beneficial ownership can be hidden through shell companies. Value can be increased through renovations. The asset can be resold later, and gatekeepers may help facilitate the transaction. So real estate is often linked with the integration stage of laundering, though it can involve layering as well. Red flags include unexplained all-cash purchases, ownership through opaque entities, third-party funding, rapid resale, unusual valuation, mismatch between the customer's profile and the size of the deal, or unnecessary complexity in who is buying and who is benefiting. AML controls here include identifying the real beneficial owner, understanding source of funds and source of wealth, reviewing the role of intermediaries, and questioning why the deal is structured the way it is. I now know that real estate can convert illicit funds into a respectable-looking long-term asset. Memory hook. Real estate can turn dirty money into an address. Section 12. International trade, free trade zones, trade-based money laundering, and black market peso exchange. Trade-based money laundering, or TBML, is the process of disguising proceeds of crime and moving value through trade transactions in an attempt to legitimize illicit origin. This is one of the biggest conceptual jumps in Seminar 2. The money may not be hidden in a single bank account. It may be hidden inside paperwork, invoices, shipment values, goods descriptions, routes, and trade relationships. TBML hides value inside trade. TBML =, value hidden inside trade. Common techniques include over-invoicing, under-invoicing, multiple invoicing, false description of goods, false quantity or quality, and phantom shipments where goods do not really move as stated. Here is the simple logic. If goods worth $100,000 are invoiced at $300,000, then an extra $200,000 may be moved under the cover of trade. If expensive goods are intentionally undervalued, value can also be shifted. Free trade zones can be relevant because large volumes of international trade may pass through them with less scrutiny than people assume, which can create opportunities for concealment. Now I turn to the black market peso exchange, or BMPE. The BMPE is a value transfer system often explained through drug proceeds. Illicit dollars generated in one country are purchased by peso brokers, placed into the financial system, and used by legitimate importers to buy goods. Those goods move back into the destination country, while the criminal value has effectively been transferred, so the criminal money is blended into trade. This is why CAMS questions on TBML are often testing whether I can see beyond the payment itself. I must also ask about the invoice, the goods, the price, the route, and the parties involved. AML controls here include understanding the customer's trade model, reviewing whether goods and values make commercial sense, watching for unusual jurisdictions, comparing expected trade activity with actual activity, screening counterparties, and escalating when the trade documentation does not line up. I now know that in trade-based money laundering, the money may not look suspicious by itself. The suspicious part may be the invoice, the goods, the value, the route, or the parties. Memory hook. TBML hides money inside trade paperwork. Section 13. New payment products and services. New payment methods include prepaid cards, mobile payments, internet-based payment services, e-money models, and virtual currency. These methods are not suspicious by default. The issue is the combination of speed, anonymity, non-face-to-face relationships, geographic reach, access to cash, segmentation of services, and unclear funding sources. The more a payment method allows value to move quickly across borders with limited clarity on identity, the more AML risk increases. Prepaid cards matter because some can be loaded and used flexibly. Mobile and internet-based systems matter because transactions can happen remotely and rapidly. Virtual currency matters because value can be moved globally without a central bank or traditional institution sitting in the middle in the usual way. Convertible virtual currency can be exchanged for fiat money or used as a substitute for real currency. Non-convertible virtual currency is usually limited to a specific ecosystem or domain. AML controls here include customer due diligence, limits on loading or geographic use, understanding funding source, record keeping, transaction monitoring, and suspicious activity reporting. I now know that new payment methods are not bad by default. The risk depends on anonymity, speed, cross-border use, funding source, redemption, and controls. Memory hook. New payment risk rises when value moves fast and identity becomes blurry. Section 14. Corporate vehicles. Shell companies, shelf companies, limited liability companies, international business companies, private investment companies, and trusts. Corporate vehicles can be legitimate business tools, but they are also classic laundering tools because they can obscure ownership, control, and a source of money. Public companies are generally more transparent and more heavily regulated. Private companies often have fewer disclosure pressures. Limited liability companies, or LLCs, can be attractive because ownership and management may be structured in ways that reduce transparency. International business companies, or IBCs, are often formed outside the owner's country of residence, sometimes in offshore jurisdictions, often for confidentiality or asset protection. Private investment companies, or PXCs, may be used to hold investment assets, often in tax-neutral jurisdictions. Now, the exam distinction that people often mix up. A shell company is a company with no significant assets or operations. A shell company is a company created earlier and left inactive, then sold or used later by someone who wants an already formed entity. Shell hides activity, shelf hides age. Both can be misused. Trusts also matter because legal title and beneficial enjoyment can be separated, which may make the true owner or controller less obvious. So when I see corporate vehicles in a CAMS question, I do not assume wrongdoing automatically. I ask whether the structure has a real commercial purpose, whether beneficial ownership is clear, and whether the layering of entities seems designed more for secrecy than for business logic. AML controls here include beneficial ownership identification, screening relevant parties, understanding the purpose of the structure, source of funds, and source of wealth review, and escalation when ownership or control cannot be clearly explained. I now know that corporate vehicles become risky when they obscure who owns, controls, benefits from, or funds the activity. Memory hook. Shell hides activity. Shelf hides age. Section 15. Terrorist financing. Now I reach one of the most important conceptual differences in the whole seminar. Money laundering and terrorist financing can look similar operationally. Both may involve structuring, wires, MSBs, hawala, cash couriers, front entities, charities, and even virtual assets. But the core difference is this. Money laundering usually begins with criminal proceeds and tries to hide the source. Terrorist financing can involve legal or illegal funds and often tries to hide the purpose and destination. That is a major CAMS exam point. Money laundering often involves larger pools of dirty money. Terrorist financing can involve smaller amounts, and those amounts may come from lawful sources such as salaries, donations, community fundraising, or legitimate businesses. That means terrorist financing can look ordinary in amount, but dangerous in purpose. Hawala and other informal value transfer systems matter because they can move value with limited formal documentation. Charities and non-profit organizations matter because most are legitimate, but some can be misused to collect or move funds. Social media matters because it can support fundraising, recruitment, and financial coordination. Virtual currency matters because it can move value globally and rapidly. Another exam idea is the money trail. Traditional laundering often looks more linear in the sense that criminal proceeds are pushed through stages. Terrorist financing can look more circular or fragmented because funds may come from various sources and then move into operational use in smaller, less obvious ways. AML controls here include screening, monitoring for unusual patterns, reviewing stated purpose against actual activity, understanding links to high-risk geographies or entities, enhanced due diligence where appropriate, and filing suspicious reports when concerns arise. I now know that terrorist financing is different from money laundering because the source of funds may be legal or illegal, but the purpose is hidden. Memory hook, money laundering hides where money came from. Terrorist financing often hides where money is going and why. Section 16, CAMS exam strategy for seminar. 2 CAMS questions in this seminar often test recognition, not just memorization. So I expect questions that ask, which industry is vulnerable to which method? Which behavior is the real red flag? What makes this suspicious rather than ordinary? Is this placement, layering, or integration? Is this money laundering or terrorist financing logic? What definition is being tested? Here are the key traps I want to remember. Do not assume all non-bank financial institutions are suspicious. Do not confuse normal credit card repayment with credit balance abuse. Do not confuse shell company and shelf company. Do not assume terrorist financing always uses illegal funds. Do not assume terrorist financing always involves large amounts. Do not treat TBML as just a payment issue. The document's goods, values, routes, and counterparties matter. Do not confuse open-loop and closed-loop prepaid access. Do not assume a securities account is normal just because securities are involved. I still ask whether the activity has investment logic. And one more big exam habit. If 2 answer choices look similar, I ask which one better explains the risk mechanism. I am not just memorizing industries, I am learning the risk logic behind each one. Memory hook. Do not memorize the label only, understand the mechanism. Section 17, final recap. I now understand that Seminar 2 is about widening my AML lens beyond banks. I now look at non-bank financial institutions, non-financial businesses and professions, professional gatekeepers, trade, payment technology, corporate vehicles, and terrorist financing. I ask the same core questions again and again. Where is the value? Who controls it? How is it moving? What is being hidden? Does the activity make commercial sense? If I keep asking those questions, this seminar becomes much easier. I understand that AML risk is often created by some combination of speed, anonymity, complexity, cross-border movement, weak visibility, or hidden beneficial ownership. And I now know that terrorist financing must be thought about differently from ordinary money laundering, because smaller amounts in lawful funds do not make the risk safe.